Good afternoon, everyone, and welcome to today's Employee Benefits Compliance webinar. As we kick off today, and as folks are still joining us, you'll see a polling question that's just popped up on your screen. We are curious if your organization is planning to add or enhance any employee benefits in an effort to improve your talent and attraction and retention. You'll notice this question allows you to just kind of free type in whatever your response may be. So whether you have a couple words, a couple sentences, or if the answer is just, hey, we're not doing anything, please take a moment and let us know your company's strategies in this area. So again, welcome to today's webinar. I am Jenny Bedell with AssurexGlobal. Today, we're going to cover taxation of benefits, and we would like to extend a special thank you to your local insurance benefits advisors and consultants who are partners of AssurexGlobal for making today's webinar possible. We will get into today's content in just a moment, but I will remind you that we do encourage and welcome your questions today. If you have questions at any time throughout the presentation, please submit them over to us using the Q&A function at the bottom of your screen. We'll get to as many of those as we can throughout our time together here today. And our sessions are recorded. A link to the recording, as well as a copy of the presentation slides, will be available early next week from the benefits advisor or consultant who invited you here today. And I will also drop a link to the presentation slides in the chat section here in just a couple of moments. I'm going to just check on this poll. I'm going to leave the poll up for a few more seconds here as folks are still continuing to join us. And I will also give you a heads up. We are actually going to ask you a few more polling questions related to today's topic. So just a heads up to keep an eye out for those questions. They're going to come kind of towards the end of today's presentation. All right. Well, thank you all for submitting those responses. Because of the nature of today's poll, I'm not able to give you my usual sneak peek, but keep an eye out for our monthly market check survey where we analyze the responses of these polls and provide some commentary. That piece of collateral will be available early next week. So if you're curious how your peers responded to this question, again, that's our market check survey. You can get that early next week from the benefits advisor who invited you here today. But for now, I will close out our poll and I will welcome today's presenters. Joining us today from the BenefitComply team, we have David Flotten, Senior Consultant, as well as Dan Brady, Senior Consultant. So gentlemen, I will hand things over to you.
Thank you, Jenny. Welcome, everybody. Today's exciting topic, as we said, is going to be taxation of benefits. It was tax day earlier this week. I'd like to say we planned that, but I think it was just a coincidence. But in any event, that's what we're going to focus on today. We're going to start with a little bit of an intro as to what we mean by taxation of benefits and how we're going to approach today's subject. And then the idea between Dan and I, we'll go back and forth on some of the most common benefits and explain how these basic principles apply to the different types of benefits that probably most of you as employers offer, or at least most of these benefits, not necessarily all of them. Okay. So let's start with this kind of basic default rule. So the default assumption is that anything of value that you as an employer provide to an employee is taxable income. And it doesn't matter whether it's cash or benefits or property or stock. Anything that's of value that you provide to an employee is presumed to be taxable and has to be reported on the W-2 unless there is a specific provision in the tax code that makes it tax-free. And when there is a specific provision in the tax code, it usually comes with a bunch of rules and strings attached as to what you have to do in order to ensure that benefit remains tax-free. And this is one of the primary reasons employers offer benefits, is because they get this tax break instead of just giving people the cash equivalent. Now, we're going to kind of gloss over detail. When we talk about something being tax-free, most of the time it is tax-free for all taxes. That means no income tax, no FICA taxes, no state taxes. It's tax-free across the board. There are a few corner cases that are exceptions. I put a couple of them up on the slide. You kind of just have to be aware if you're in one of those states or dealing with one of these more corner case benefits. But for the most part, when we say something's tax-free, it's tax-free. Now, when we talk about something being tax-free, we actually have to kind of talk about three different things, right? So the first question is, to the extent that the employer is paying for a benefit, is that employer contribution tax-free or is it taxable? The second question then is, to the extent that the employee is paying for that benefit or a portion of it, can they do so tax-free? That is, can they use your cafeteria plan to pay for this through pre-tax payroll deductions, or do they have to do it after tax? Now, you have to have a cafeteria plan to do it pre-tax, but even if we do, not everything can be put through the cafeteria plan on a pre-tax basis. And we're going to see there are some benefits that you can pre-tax, but it's not necessarily a good idea. Okay? And then the final thing we have to talk about is the benefit itself. If I actually go and use my health insurance or my disability and I get paid, or my doctor gets paid, is that benefit tax-free or is it taxable? So those are the three things we're going to focus on. And then we're going to see when we get to life insurance. Life insurance is kind of a special case. There are tax issues there, but what gets taxed is a little different from all the other benefits we're going to talk about. All right. So let's start basic. Medical, dental, vision coverage, collectively, we'll talk about these as health plans. Most of us probably at least offer medical and dental. And as you can see, this is tax-free across the board. Any employer contributions to these plans are tax-free. Any employee contributions can be paid pre-tax through the cafeteria plan. And any benefits the employees receive, at least to the extent that they are medical care, are also going to be a tax-free benefit. So seems straightforward, but of course there's always caveats to everything. So let's start with this first basic question, which is tax-free to whom? And there's actually four categories, four groups of people whom we can provide tax-free health coverage. And those groups are current and former employees, spouses, children under age 27 as of the last day of the calendar year, and tax dependents. Now, it's important to keep in mind what we're talking about here is tax-free benefits. This is not the same thing as eligibility. So I know a lot of you are probably saying, well, wait a minute, we only cover children to age 26. And that's true, you probably do. That's the age 26 mandate under the ACA. All this is saying is, if by chance the coverage goes beyond the child's 26th birthday, it can remain tax-free to the end of the year. Doesn't mean they're eligible, just means if it exists, it can be tax-free. Same is true of tax dependents. Just because somebody is a tax dependent does not mean they're eligible for benefits under your plan. They still have to qualify as an eligible dependent. All this is saying is, if they do qualify as a tax dependent and they do get coverage, then it will be tax-free. Now, there are people we provide coverage to who fall outside of these four categories. And so for those people, the coverage is not going to be tax-free. Okay? So for example, we get asked sometimes, can I provide coverage to my independent contractors, so people I pay through a 1099? Usually the answer is no, only employees are eligible. But even if you can convince the carrier to let you cover independent contractors, by definition, they are not employees. And therefore, any coverage you do provide to them is not tax-free. It has to be reported as taxable income on the 1099. Far more commonly is domestic partners and their children. Lots of employers provide coverage to domestic partners, but they are by definition not spouses, which means that unless they happen to be tax dependents, the coverage to the domestic partners is not tax-free either. Some other things that can come up, children who are over age 27, so a lot of plans will cover disabled adult children. Oftentimes they are tax dependents, so there's no tax issue, but not always. And so if you're covering a disabled adult child who is not the employee's tax dependent, that's not tax-free coverage. Ex-spouses is another common one. And if an ex-spouse gets left on a plan, one, they probably shouldn't be there, but two, even if they are there, it's not tax-free coverage. Now, Dan, do you want to talk a little bit about, let's talk about domestic partners in particular, but what does that mean then that it's not a tax-free benefit?
Yeah, absolutely. So what's kind of the practical process for providing coverage on a taxable basis for these individuals? And using domestic partners as an example, what happens is the employer has to impute the fair market value of the coverage as taxable income to the employee. So the employee will have imputed income to report on their W-2 subject to taxes. Uh, in typical regulatory fashion, we do not have guidance as far as how to define fair market value. There are two kind of common approaches that employers will use, either the COBRA premium for self-only coverage, less that 2% admin fee, or as an alternative, they'll take the incremental cost of providing coverage for the second individual. So you have your cost for employee only coverage and you have your cost for employee plus one. You're taking the difference there, and that's sort of your fair market value of coverage. One thing to note is that there does have to be some sort of value assigned to that coverage. If it's employee only versus family, um, the employer does have to assign some sort of value to that domestic partner's coverage. The next step is that the portion of the coverage paid for by um, the employer, uh, paid for by the employee, um, has to be paid on an after-tax basis. These individuals can't participate in the cafeteria plan and pay for coverage on a pre-tax basis. So typically that, like for a domestic partner, for example, you'll have their coverage paid after tax. Alternatively, and what a lot of employers find a little bit easier administratively, is that the employee will pay for the coverage on a pre-tax basis. And in that case, the employer has to impute the full value of the coverage as taxable income. One other thing that comes up quite a bit is, how does an employer determine who is a tax dependent using the domestic partner, for example? How would an employer know if a domestic partner is a tax dependent? The IRS allows the employee to certify to that. I think the most common approach is simply to have the employee sign some sort of affidavit saying that, my domestic partner does qualify as a tax dependent.
Maybe one thing just to follow up on a question here. Once you go through this exercise of taxing the premiums, the employer share and the employee share as appropriate, the benefit itself is then still tax-free. So we don't have to worry about claims paid out on the back end. It's just in this case, context, the premiums are what we're concerned with. That's what has to get taxed. And there's another question. Is this true for a married couple? No, they're spouses. Spouses can have tax-free coverage.
So we've got kind of
Well,
another group.
go ahead, sir.
We've got kind of another group here who are the tax. There's different tax implications. So these are also essentially non-employees, and the IRS deems these individuals self-employed. So these are going to be your owners, so sole proprietors, partners in a partnership, more than 2% shareholders in S corps. These individuals cannot participate in the cafeteria plan, which means that any medical, dental, or vision coverage, the premium must be paid on an after-tax basis. There's kind of a special rule with more than 2% S Corp owners, referred to as ownership attribution rules, where essentially the family members of these owners are also limited and cannot participate if employees cannot participate on a pre-tax basis. So that's something that needs to be considered when owners and their family members are eligible. So we wanted to kind of talk a little bit about non-discrimination rules. Everyone's probably heard of those, but the reason we wanted to include them in today's presentation is essentially this fact that if the plan is determined to be discriminatory, there are tax implications for certain highly compensated individuals. Each of the benefits that we'll talk about today, or most of the benefits we'll talk about today, there are different sections of the tax code that apply different non-discrimination rules. But for the most part, they all sort of provide that the plan cannot discriminate in favor of highly compensated individuals. Each of the tax code sections has different definitions of who is considered highly compensated. We decided to highlight self-insured plans here, which are governed under Section 105. You can see the definition of highly compensated here. You're going to have your five highest paid officers, 10% shareholders, and highest paid 25% of all employees. As I mentioned, if the plan is determined to discriminate in favor of these individuals, then the benefits provided to these individuals are taxable. Determining exactly which benefits are taxable depends a little bit on which test is failed, and there's different non-discrimination tests under each of these code sections, so it gets fairly complex. But the important thing to remember is that a discriminatory plan essentially results in tax implications for these highly compensated employees. As a practical matter, it's relatively common for employers not to run specific non-discrimination testing under Section 105, but we've included a few examples or sort of red flags here which can result in discriminatory plans. For example, if highly compensated individuals are allowed to participate and non-highly compensated individuals are not, that's a red flag. If highly compensated individuals are required to pay less for the same coverage, that's another red flag. And then if highly compensated individuals are receiving better benefits, shorter waiting period, those are also things to consider in terms of non-discrimination rules.
One thing before we move on, we've got a couple of people asking questions going back to owners. What if the company pays the premiums? How is that taxable? Where does that get reported? For those questions, I would always punt to your tax advisor because it very much depends on the form of the corporation as to whether the company can pay for it, and if so, how it gets reported. But in a lot of cases, yes, if the company is paying the premiums for an owner's benefits, it very often has to go on something like a K-1 or maybe a W-2. But again, the specifics vary enormously. So definitely please talk to your tax advisor about those issues. All right, so let's go talk about a more specific type of medical plan, namely an HRA or a health reimbursement arrangement. For the most part, this is going to follow the same rules as general major medical with a couple of caveats. One, HRAs by definition have to be funded solely by the employer. There are no employee contributions. So our middle bucket here is kind of a not applicable because there just aren't any employee contributions. But for the most part, the HRA is tax-free for the same group of people for whom it's medical in general is tax-free. The bigger issue with HRAs is really actually not so much the taxation, but can these people even participate if they are not entitled to tax-free coverage? So if I've got somebody who doesn't fall within those four categories, can I even let them participate in the HRA? And the IRS has answered that question for one very specific group, which is domestic partners and their children. And they have said domestic partners can participate in the HRA, but only if you tax the employee on the value of that domestic partner's coverage. Now, that raises all the same questions Dan raised, but even more complicated in an HRA, which is how do you value the domestic partner's HRA coverage to report it as taxable income? It might just be easier to say we're not going to let domestic partners participate. But for other people who are outside that list, so for example, can I allow an independent contractor to participate in the HRA? There's no clear answer, and the conservative answer should be no. They're not allowed to participate because they are not entitled to tax-free benefits. So other than domestic partners, if they're not on that tax-free list, they should probably be left out of the HRA, which is also an issue for owners.
Yep. And as David mentioned, we really only have guidance sort of specific to domestic partners with this respect. The IRS has not addressed whether owners can participate on an HRA on a post-tax basis, but informal comments has suggested that that is not allowed, like it is for domestic partners. HRAs are also subject to non-discrimination rules as a self-insured plan, Section 105. So again, here we're looking at whether the HRA provides more benefits to highly compensated individuals. That's certainly going to be an issue. If the discrimination testing fails, then the HCIs are taxed on the value of the excess benefit under the HRA. We had a question about how often do you have to do the non-discrimination testing? The regulations aren't super clear. I think the kind of general understanding is that the testing has to be done every year, and each code section is a little bit different with respect to the language as far as testing. But one reason that best practice is to test every year, and especially early on or midway through the year, is that a lot of times corrections can be made. So the plan is found to be discriminatory. You can stop contributions for these highly compensated individuals, and a lot of times bring the plan back into compliance rather than waiting until the end of the year when corrections typically aren't available.
We'll say, we said that major medical plans, people don't routinely test those. These do get routinely tested. Most HRA vendors will offer this as a service. They may charge you for it, but they will offer you to test the HRA for you. All right, let's talk about another account-based plan, a health savings account. Now, these do get a little different. Superficially, this looks the same, right? Employer money that goes into the HSA is tax-free. Employee money that goes into the HSA is tax-free. Benefits that come out of the HSA, at least when used for medical expenses, is also tax-free. There's a lot more nuances here, though, as well as a couple of quirky things that are different from how some of the other health benefits work. So if we start with contributions, so first of all, employer and employee payroll contributions, that is pre-tax deductions through the employee's paycheck, those are tax-free as long as it's reasonable for the employer to believe the employee is entitled to take tax-free contributions at the time the contribution is made. And I am entitled to a tax-free HSA contribution if I am enrolled in a qualified high-deductible health plan. I'm not enrolled in any coverage that's not a high deductible health plan. So for example, Medicare would be disqualifying coverage. The general purpose health FSA would be disqualifying coverage. And I have contributed less than the annual contribution level based on my HDHP coverage type, single versus family, and my age. Now, as the employer, you are only required to monitor what goes on within the confines of your business. Okay, so you only have to pay attention to what is the employee enrolled on through my benefit plans and how much money has gone through my payroll. Anything that happens outside, if the employee doesn't tell you about it, that's not your responsibility, that's the employee's. So if they enroll in Medicare and they don't tell you, that's on them, not on you. Once you know they're enrolled in Medicare, that's different. But you don't have to ask, you don't have to go hunting down what they're doing outside. Same as if the employee puts in the full annual contribution through payroll and unbeknownst to you makes an additional contribution outside payroll that puts them over the contribution limit, that's on the employee, that's not on you. Okay? Now, if the employee does manage to put in more than they're allowed to put in, they are going to owe income tax on that excess and an excise tax. And that excise tax is going to continue year after year until the excess contribution is pulled out. You can avoid the excise tax if you pull the excess contribution out before April 15th of the following year. So sorry, too late to do that now. But that doesn't avoid the income tax, even if you do that. The other thing is those annual maximum contribution limits assume the employee is HSA eligible for the entire year. If the employee is only HSA eligible part of the year, they're a new hire and join mid-year, or they enroll in Medicare in the middle of the year. If they're only HSA eligible part of the year, their annual contribution limit is going to get prorated based on the number of months they are HSA eligible. There are some ways around it in some circumstances, but that's the basic assumption. The good news, you as the employer do not have to watch out for and monitor prorated contribution limits. All you care about is the overall annual contribution limit.
So there are also going to be tax implications depending on how the employee uses their HSA funds. So in order for the HSA funds, the distributions to be tax-free, the funds must be used for eligible medical expenses as defined under Section 213. The funds must be used for employee, spouse, and tax dependents. So medical expenses of adult children, domestic partners, and their children who are not tax dependents, those funds cannot be used on a tax-free basis. There are also tax implications when the funds are used to pay for expenses that do not qualify as medical expenses under 213. In that case, the distribution is included in income and subject to a 20% penalty tax. So pretty significant penalty if you're just going to pull money out of your HSA for non-medical expenses. The one exception there, if the HSA account holder is over 65 years of age, they can then take the funds out and will not be subject to the 20% penalty, although the amounts will still be included in income. We get a lot of questions about kind of mistaken distributions. And a lot of times you can reach out to your HSA custodian and they'll essentially allow you to refund the HSA account, put the money back in to avoid those tax implications.
Probably the biggest trap here is those adult children, because it is confusing. You can have an adult child who's on the HDHP, totally fine, but if they're not the employee's tax dependent, the employee can't use the HSA for them. So you have to be careful. It's not whether the child is on the HDHP that matters. It's whether the child is a tax dependent as to whether the employee can use the HSA money for that child's expenses. The good news is if that child is not a tax dependent, they can open their own HSA. So the employee can't use their HSA funds, but the child can put money in their own. Same is true would be for a domestic partner who's not a tax dependent. The employee can't use their HSA money for the domestic partner's expenses, but the domestic partner can open their own HSA.
So owners and HSA. So this is a kind of group that we see a lot of confusion around. Owners cannot participate on a pre-tax basis. So the distinction here is the eligibility for the cafeteria plan versus eligibility for an HSA. Owners cannot participate in a cafeteria plan on a pre-tax basis. However, the eligibility rules for HSAs don't speak to owners at all. David touched on those. You have to have qualifying HDHP coverage. You can't have any disqualifying coverage, and so an owner could theoretically be HSA eligible, and although they cannot contribute to that HSA on a pre-tax basis through the cafeteria plan, they can still contribute to the HSA on an after-tax basis. So one thing to keep in mind if you have owners who are HSA eligible.
All right. Health FSAs and DCAPs. Now, these are part of the cafeteria plan. So a lot of things we've been saying about cafeteria plans are going to be equally applicable here to a health FSA and a DCAP. And again, you can see for the most part, these are tax-free across the board. Any employer contributions are tax-free, employee contributions are tax-free, the benefits are tax-free, but there are some significant restrictions when it comes to these particular types of plans. So first of all, most employers don't contribute to health FSAs and DCAPs, but if they do, there are some important limitations on that. First of all, for the health FSA, an employer should never put in more than $500 of employer money, but any money they do put in doesn't count against the employee's contribution limit. By contrast, a DCAP, as you can see at the bottom of the slide, has a $5,000 annual limit, and any employer contributions do count towards that limit. Now, in terms of employee contributions, the health FSA has an annual limit that's indexed for inflation. It's currently $3,300. The DCAP also has an overall $5,000 limit that is not indexed, and it stays the same from year to year. Okay. As far as getting money out with a health FSA, what you can use it on is medical expenses. And again, those same four groups of people we've been talking about: current and former employees, spouses, children under age 27, and tax dependents. So notice here, health FSAs are different from HSAs, okay? You can use an FSA to pay the medical expenses of your 24-year-old non-tax dependent. You cannot use your HSA money to pay the medical expenses of your 24-year-old non-tax dependent. So they look similar, but the rules are different. And then, of course, a DCAP we use for daycare expenses, usually for children under 13, but it can sometimes be used for like an elderly parent who you care for and has to go to daycare while you go to work.
So we've got some special rules for owners here again. So under health FSA, owners cannot participate. FSA eligibility is extended only to common law employees, and in virtually all instances is going to be extended only to those employees who are eligible for the major medical plan. The DCAP rules are a little bit different. In most cases, it's going to be extended only to common law employees. However, certain self-employed individuals can technically participate in a DCAP, just not through the cafeteria plan. So it is possible to set up a separate DCAP for certain self-employed individuals. However, that can raise certain non-discrimination issues, which I will talk about in a second. So health FSAs are self-insured plans and subject to 105H. As I mentioned, there are different code sections depending on the benefit. So DCAP benefits are subject to a different code section, non-discrimination under 129. Essentially the exact same effect, right? If the plan is found to be discriminated in favor of highly compensated individuals, then those highly compensated individuals will lose the tax benefit. One example of a test that we see failed all of the time under the DCAP benefit is the 55% average benefits test. This is a utilization test that looks at the ratio of highly compensated and non-highly compensated individuals and who is participating. If the highly comps are participating disproportionately at higher levels, which is common, then the plan is likely to fail the non-discrimination testing. Again, this is a reason to test early because a lot of times you can change the contributions of those highly compensated employees to then pass the test. We had another question about non-discrimination testing. If a benefit passes the test and doesn't make any changes to the benefit year after year, do they have to continue testing? Technically, yes, because you do run into these utilization situations where maybe 1 year HCEs won't utilize the benefit as much and the test will pass. And then the following year, you'll have a different turnout. More HCEs are using the benefit disproportionately, and then you could fail. So although maybe the chances of failing are less likely if the benefit's not changing, there are certain utilization aspects that best practice is to then test year after year.
All right, let's change gear, talk about life insurance. As I mentioned at the beginning, this life insurance is a little different in terms of what gets taxed, okay? But if we start with our basic three, any employer contributions to life insurance, that is tax-free. Employee contributions, so here's we run into the first time we've said this. You can pre-tax employee life insurance premiums, but it's actually not recommended because it's actually going to create additional tax problems if you do that. So you can do it, not a good idea. The life insurance proceeds, if the employee dies and the money goes to their beneficiary, that is always going to be a tax-free benefit. So what is it that can get taxed when we're talking about life insurance? So under Section 679 of the tax code, an employer can provide up to $50,000 of what we call employer carried life insurance on a tax-free basis. So this is why you see a lot of base life plans are set at $50,000 because that's how much can be provided tax-free. If the employer provides more than $50,000 in life insurance, then the amount above that, the value of that coverage gets taxed. So if I, as an employer, provide base life of 2 times salary, and I have an employee earning $75,000, so they get $150,000 of base life, the first $50,000 of that is tax-free. The next $100,000 of that coverage is not. And we'll get to on the next slide how you figure out how much has to get taxed. Okay? Now, we usually talk about life insurance as base life insurance paid by the employer, voluntary life insurance paid by the employee, but that voluntary life insurance can be treated as employer paid in a couple of situations. First of all, if the employer pays any portion of the voluntary life, it gets treated as employer carried. Well, as far as the IRS is concerned, pre-tax premiums are not employee contributions, they're employer contributions. So this is the reason we say you can pre-tax it, but don't, because the minute the employee pre-taxes that voluntary life insurance, it's employer carried, and it's subject to this $50,000 tax-free limit. Okay. The other way that voluntary coverage can turn into employer coverage is if the rates do what we call straddle table 1. And what that means is if the voluntary premiums have at least one employee whose premiums are higher than the table 1 rate, and at least one employee whose premiums are lower than the table 1 rate, the rates are said to straddle table 1, and now that entire policy is an employer carried policy. So here's the infamous table 1. This is in the tax code, and what it is, it's saying on the left, if you're in this age bracket, this is what the value of each $1,000 of life insurance is worth per month. Regardless of what premium the carrier charges, this is what it's worth. And so let's take my example of the employee who got $150,000 of base life from their employer. We'll assume that employee is age 50, so they're in the 50 to 54 age bracket. They have $100,000 of excess life insurance, which is worth 23 cents per $1,000 or $23 per month. So that employee would have to have $23 per month of imputed income added to their W-2 and taxes withheld. Okay. So that's what's getting taxed is the value of that life insurance above $50,000. Okay. And again, we use the table 1 to figure out what that value is. And again, while you can pre-tax employee premiums, we don't recommend it because you're going to turn it into employer carried. So I just have an example using the same 100,000 as a matter of fact, where the only difference here is if the employee pays the voluntary life premiums pre-tax or after tax. If they pay the voluntary life premiums after tax, there's no tax consequence. If they pay the voluntary life premium pre-tax, suddenly you have $23 a month in imputed income you need to add to the employee's W-2, which is probably going to wipe out whatever tax savings they got from pre-taxing the premiums in the first place. So again, you can pre-tax voluntary life premiums, don't do it.
So moving to our 4th and final non-discrimination rule, it applies to life insurance under Code Section 79. Like all the other non-discrimination rules, if the life insurance is discriminatory, then all of the key employees lose the exclusion from income for the first $50,000 of coverage. As I mentioned, the definition of key employer highly compensated is different depending on the code section. So here we're looking at certain officers with compensation in excess of $230,000, which is indexed, more than 5% owners, more than 1% owners with compensation in excess of $150,000. And then we have an example there. Plans can, with a life insurance, plans can be designed to automatically pass the non-discrimination testing. For example, if the plan covers all employees at a fixed percentage of compensation, then the plan will automatically pass the testing.
Just going to breeze through dependent life insurance because it's not a very common benefit. Couple of things here. First of all, if the employer pays for dependent life insurance, they can only provide $2,000 of coverage tax-free. If the employer pays for more than $2,000 of dependent life coverage, and that includes dependent spouse or dependent child, then none of it is tax-free. So it isn't like the base life where it's the amount above 50,000. This is you give $2,000 tax-free or you give none tax-free. Most employers don't contribute to dependent life at all. If they offer it, the employee has to pay for it. This is not a cafeteria plan eligible benefit. Employees cannot pre-tax a premium for spouse life insurance or dependent child life insurance. Okay, we're going to talk then next about disability coverage and indemnity plans or voluntary plans. And when we get not quite to the end of this section, we're actually going to ask you some poll questions about how you handle the premiums for these types of benefits. So keep that in mind as we're going through here. Think about what you do, and then we're going to put up some poll questions to get us, people can get a flavor, get a sense of how different employers do this. Now, disability taxation is one of the most complex topics in this area because it is very interdependent. What gets taxed and what doesn't depends on what happens to the premiums at the front end. Okay. There's also a lot of back and forth between the insurance company and the employer as to who has to do what, who has to do the reporting, who has to do the withholding. So this can get very messy, and we'll give you a reference source near the end of this where to look if you need to get into the details of it. But here's the basics of what I try to describe when it comes to disability. I kind of use this yin-yang model. And it kind of, what happens to the premiums tells you what happens to the benefits, all right? So if the disability premiums are taxed, the employees don't pay them the disability premiums pre-tax, the employer premiums get taxed. Now the disability benefits, if the employee becomes disabled, come out tax-free, which is usually the better deal, right? Because what disability typically pays maybe 2/3 or 70% of salary. Ideally, I'd like to get all of that 2/3 and not have taxes taken out of that. But for that to happen, the premiums have to be taxed. Because if we flip it around, if the disability premiums are not taxed, if they are deducted pre-tax or the employer pays for them, now the disability benefits are going to get taxed on the back end. So what happens to the benefit, the premiums, whether they're taxed or not, will tell you whether the benefits get taxed or not, with them going opposite one another. And then heaven forbid you have a year where you have a mix of both taxed and untaxed benefits, because that triggers this 3-year look back thing to determine how much of the benefit gets taxed. The simple answer is try to avoid this. It's either all taxed or all not taxed. We only have to do the look back if it's a mix in a given year. So you can switch from taxed to not taxed from one year to the next. That's okay. Just try not to have a mix of taxed and not taxed in the same policy year. Now, we're kind of assuming here we're talking about a fully insured disability plan. If you have a self-funded plan, those benefits will always be taxed, okay? There are some special rules if you happen to charge a premium for your self-funded disability benefit. Most employers don't, so we don't usually get into that. But it's almost impossible to make it a totally tax-free benefit if it's a self-funded plan. Now, a couple of tips and tricks when it comes to disability premiums. So first of all, if you as the employer want to pay the premium for disability coverage because you think it's important, but you also want to make sure it's a tax-free benefit, to make that happen, you have to tax the premiums that you are paying. And this is what we call a gross up. And the basic gist, what happens is so let's say that the premiums are $15 a month or $15 a pay period, okay? What's going to happen with a gross up is on the employee's paycheck, you're going to take their gross pay, you're going to add $15, the amount of the disability premium. You're going to calculate and withhold tax on that combined amount. Now you've just taxed the $15. And then after tax, you're going to deduct that $15 premium. The net effect of that is that premium has now gotten taxed, but the employee hasn't actually received the $15 or had to pay it themselves. You've paid it. So now that the premium has been taxed, now the benefit can be tax-free. Same thing we've said, you can pre-tax disability premiums, but we recommend you not do it. Otherwise, the benefit is going to get taxed. And here, the carrier, if you've got a fully insured plan, the disability carrier really needs to know what you're doing. Are you doing a gross up? Are employees paying the premiums pre-tax? Because it affects what they do with the benefits on the back end as to in terms of tax reporting, tax withholding. So you need to make sure they know how you're handling those premiums. And we run into problems all the time where, you get done with our webinar here and go, boy, that gross up sounds really cool. Let's go do that. And we don't tell the carrier, well, now you've messed up the taxes if they pay benefits. Or you tell the carrier we're going to do a gross up and then we never do it. That's just as problematic. Now, if the benefit does wind up getting taxed, who has to pay the tax and how it gets reported is really messy because you and the carrier can kind of pass responsibility back and forth. We'd refer you to IRS Publication 15A. Chapter 6 is sick pay reporting that goes through it all in gory detail if you need to review it. The main thing is if you are winding up with a taxable benefit, pay very close attention to the contract you're signing with the carrier, because somewhere in there it's probably going to talk about who's responsible for what. And you want to make sure you know what you're doing versus what they're going to do. Indemnity plans are somewhat similar. Now, first of all, what I mean by an indemnity plan, we're usually talking hospital indemnity plans, cancer plans, AD&D plans. These are plans that don't directly reimburse medical care. What they do is they pay a fixed dollar amount when certain events happen. So a hospital indemnity plan, for example, says you get $500 a day every day you're in the hospital. Doesn't matter what your actual medical bills are, just every day in the hospital, you get $500. There's a little bit of the same yin yang going on here as with disability benefits. If the indemnity premiums are tax-free, the benefits that come out can be taxed. If the indemnity premiums are taxed, then the benefits that come out will always be tax-free. Okay? The biggest difference here is that with disability, it's kind of all or nothing. Either all of the benefits are taxed or all of the benefits are not taxed. With indemnity plans, if the benefit is taxable, so if you did the premiums pre-tax, they don't necessarily get taxed on all of the benefits, just those benefits that exceed out-of-pocket medical expenses. Part of the difficulty here with indemnity plans, the IRS has this whole elaborate process and procedure and rules around taxing disability benefits, and that doesn't exist on the indemnity side. Which means even if the employee ends up having to pay tax on their indemnity benefit, it's not obvious that they should or how they go about doing it. And so very likely it's going to get overlooked. And now you've just created a hidden tax trap for people. So again, this is why we generally recommend indemnity plans. Yes, the employee can pre-tax it, but generally we recommend that they don't. So I think I actually going to launch our poll here before we go on to the next slide. And what we wanted to know was, we got kind of 3 questions. What do you do? How do you handle the disability premiums? Do you allow employees to pre-tax it? Do you tell them they have to post-tax it? Do you let the employees choose? Same question with your voluntary benefits if you offer indemnity benefits. Is it pre-tax, post-tax, or a choice? And then the third question that's down there is, do you provide education to employees? Do you talk to them about why certain things are allowed to be pre-tax and certain things are not? Or if you give them the choice, do you sit down and explain to them? I remember my first job where I had disability benefits, that was part of the discussion was, okay, you can choose which do you want, and here's the consequences of it. So, which I thought was really good. I worked for an insurance brokerage, so they better have done that, right? But still, I think that is good. If you're going to give people a choice, they have to understand why that choice makes a difference. All right, well, we're letting people answer the questions. Any questions we want to cover, Dan?
Let's see. How often should you do a gross up per payroll? Weekly, monthly, yearly?
So the most convenient thing for the employee is to do it each pay period. Because that way it just automatically gets baked into their paycheck. It comes out of their check. The taxes come out of their check on a biweekly or whatever, semi-monthly basis. It all then gets reported correctly on the W-2, and there's no surprises. You are allowed to do it annually. You can just wait until the end of the year and figure out the total amount that should be taxed and then stick it on the W-2. The problem is by doing that, you haven't been withholding the tax throughout the year. So when the employee goes to do their taxes, there's going to be this chunk of money that never had taxes withheld that they're going to owe extra taxes on. So our general advice is to do it per pay period.
Is it typical to pass the premiums for disability to employees, or is it most often 100% employer paid?
That is not, I don't think I can say one way or the other. I mean, there's lots of employers who do pay for at least long-term disability, plenty more who pay for short-term because they feel it's important. And it is one of those things. You're actually far more likely to be disabled and not able to work than you are to die. Yet employers pay for life insurance and not disability coverage. So it really is all over the map. I think there are more employers who do pay for disability coverage, but there's also still an awful lot where it is strictly a voluntary benefit. Okay, I think we've slowed down here. So very interesting as a mix. Let's see, so I gotta do end poll and then I can share the results. So on the disability side, big chunk, 75% of you are having employees pay with post-tax dollars. So that's not surprising. I think once most people realize that's how we make sure that the benefit is tax-free, a lot of people are going to make that choice. So that doesn't surprise me too much. Another 18% employees do pay with pre-tax dollars, which is fine. It's not illegal. Just recognize what the consequence of that is. And then about 7% of you are giving people the choice. On the voluntary benefits, fairly similar split. Most of you are doing post-tax, so you realize there is this tax trap lurking out there. Maybe a few more percentage doing pre-tax dollars. And then there is this other category here, which is different options for different voluntary benefits. It's not uncommon, like for the Aflacs or the Colonials of the world, to say, hey, we'll pay for your cafeteria plan administration if you let people pre-tax this. Well, it's tempting to say, okay, go ahead. But realizing that that's, I don't want to do that on the disability side because it's really going to create a problem for my employees. And then, so our last question is, do you provide education to employees around the tax implications? And you can see quite a few, the answer is yes. 45% at different times, either a time of higher annual enrollment or throughout the year. And but there's still the majority of technically 55% said, no, we don't provide any education. Now, if you're not giving them a choice, maybe the education isn't so important. This is just what we're doing. But certainly where there's a choice, and I would advocate that even where there is no choice, because it looks strange, why do I get to pay these things pre-tax and not these things? Education can be a very useful tool. All right, get back to our slides. Last thing on indemnity, Dan is going to talk to you about wellness tax schemes.
Yeah, I'm sure we've all been approached by a vendor, someone talking about a program that promotes tax savings. For example, employees will have the same or better take-home pay. We see a lot of these. They are structured differently. It would be impossible to cover all of them. Most often they are kind of promoted as an indemnity or wellness program or some sort of hybrid. But the basic structure, one of the structures that we see is that the employee essentially pays a large monthly pre-tax premium. They complete some sort of health-related activity, which could be as simple as watching a video or calling into a number or a counseling session. And they are then paid an amount close to the premium, supposedly on a tax-free basis, the net effect being that there's a significant reduction in taxable income and increase in take-home pay. The reason we included is that these can raise some tax concerns. It's not necessarily that the programs themselves are all bad, but what happens is that the employer and employees don't know how to treat them from a tax standpoint, which often results in both of those groups underpaying income and payroll taxes. So we just wanted to make a point that the IRS is very much aware of these sort of programs. A lot of times the vendors will even comment on IRS opinion letters and guidance that has been issued in the past few years. But the IRS is aware of them. And kind of our just general guidance is that, if it sounds too good to be true, there's a chance that it is. So it's just something to be aware of and something to discuss with a tax advisor. And then finally, just a few other benefits that can be offered on a tax-free basis. We have qualified transportation plans. In that case, both employer and employee contributions can be made on a tax-favored basis. Long-term care, an exception there, the employer but not the employee premium contribution can be made on a tax-favored basis. Adoption assistant plans, educational assistance plans can be provided tax-free. On the taxable side, if you have a wellness program or providing any sort of cash or cash equivalent, most often those benefits or rewards, I should say, are going to be taxable. We had a question about, whether there was a minimum sort of gift card amount that in which case a de minimis amount that would not need to be taxable. There is no exception for that. If the wellness program, for example, does provide, let's say, an HSA contribution or HRA contribution, and those benefits are otherwise tax-free, then as part of the wellness program, they will be tax-free as well. Lifestyle accounts really depends on what the program is, but in most cases, the reward or benefit is going to be taxable.
All right, we do have a few questions that I think we have a little bit of time for. So let's see if we can answer some of them. So somebody says, is there a chart you can provide on these taxable items? Ask the broker who invited you here. They may have one, or if they are a client of ours, we may be able to provide one through them. So definitely ask for that. Another one, somebody says to the employer, we, the employer, pay the entire premium for both short-term and long-term disability. To confirm, we have to have the employees pay taxes. So first of all, to confirm, if you, the employer, are paying all of the STD and LTD premiums and you're not doing a gross up, then it is true that the employees will have to pay tax on the benefit on the back end. But it's not you who will be handling the taxes necessarily directly. You need to let the carrier know that you're paying the premiums, that you're not doing a gross up. And then we get into this whole song and dance about who's going to withhold the income taxes. It's not mandatory who's going to pay the FICA taxes. That's where it gets messy. So there is going to be tax in that situation, but it's not like you're going to be deducting it out of their paycheck or anything like that. It's more convoluted than that.
There's a question about our parking benefits tax-free. That's going to sort of depend. There are qualified transportation plans in which benefits can be provided on a tax-free basis. But there are certain restrictions like there are with all of these tax-free benefits. If it was a situation where the employer is just saying, hey, here's $50, $100 a month to cover parking, and they're not following the specific requirements for a tax-free benefit, then that would just be treated as taxable cash essentially and would be taxable.
Going back to HSA contributions and owners, and Dan talked about how owners can participate in the HSA. They can contribute to the HSA. They just can't do so through pre-tax payroll contributions. And so the question is, well, what would be the point? What's the benefit of doing an after-tax HSA contribution if they can't run it through the cafeteria plan? They will get the tax break. It's just they have to get it on their tax return. So the owner will put money in after tax to the HSA. Then when they go to do their tax return at the end of the year, they can claim a deduction for those amounts. So they do actually ultimately get the tax break. It's just how they get it. And they are also, by not being able to go through payroll, they're not getting a tax break on the FICA taxes, nor are you as the employer. So they do ultimately get it. It's just where they get it or how they get it.
There's a question about, I think this is an HSA question. Employee has family coverage with the annual limit. They can use their HSA funds to pay for the qualified medical expenses of the employee, the spouse, and tax dependents. There's a separate rules as far as who then can open their own HSA account, which is where it gets a little bit confusing. And so like if an adult child of an employee would have to themselves be HSA eligible and in order to open their own HSA account and make contributions. And those rules are separate than who can be provided tax-free distributions.
All right. We are at the top of the hour. There's a few more out there. I'm sorry we couldn't get to everybody, but go back, pose your question to the broker who invited you, and I'm sure we can get an answer somehow in most cases there.
Great. Thanks, David. Thanks, Dan. Thanks to our audience for tuning in. And if you weren't with us right at the top of the hour when we kicked off, I had asked a polling question around whether your company plans to enhance or expand the employee benefits offering in order to kind of improve your talent attraction and retention initiatives. So if we didn't capture your response at the beginning, you're going to see that poll come up again here. We'd love to hear your feedback on that. And if you already answered that, no need to respond again. As we close out here, I'll just remind you, we do record our webinars. And so a link to the recording, as well as a copy of the presentation slides, will be available from that benefits broker who invited you here today. And as David said, if we weren't able to get to your question, check in with those folks. They can help get you an answer. I do appreciate all of you tuning in. We are certainly grateful to those local brokers and consultants who are partners of AssureXglobal for making these webinars possible. I'm going to leave the poll up here for just another few seconds. We always appreciate your perspectives on these polls. I think it's just very interesting to hear right from you all on kind of your thoughts and approaches to the various questions that we ask you. All right, perfect. Well, again, thank you all for tuning in. Thank you, David and Dan. Wishing you all a great afternoon, and we'll see you next month.
Thanks, everyone.
Thanks.